Does Warren Buffett know something that we don't? Why Buffett is staying away from the markets? Warren Buffett has taken a whopping $325 billion off his investments from the equity market and is holding it in Treasury bills. Something which is the very antithesis of what Buffett is known for. The Berkshire Hathaway founder is known to buy a stock and hold it forever. But a question which is bothering many is, if the world's most followed investor doesn't feel comfortable investing, should the rest of us be worried? His company has aggressively cut down two of its largest shareholdings, Apple and Bank of America, over the past few months. In fact, he hasn't bought any stock in the last 6 months. Those of you who are familiar with Buffett and Munger's investment style would be aware that both investing stalwarts are not known for timing the market. Both like to find stocks which have intrinsic value, buy, and hold. In Munger's words, there's no point in interrupting compounding unnecessarily. So what could be the reason behind Buffett and Munger's decision to stay away from the markets? Could it be the stretched valuation? Experts believe although valuations in some stocks is stretched, there are no indications of a crash. Some are pointing out that S&P 500's return over the next decade would average just 3% a year, which is less than a third of the post-war pace. In fact, asset managers like Vanguard recently predicted an annual return range of 3% to 5% for large US stocks and just 0.1% to 2.1% for growth stocks over a decade. But what does the Buffett indicator say? The indicator is a ratio of all listed stocks to the size of the US economy. Taking the Wilshire 5000 index as a proxy, it is now around 200%, which would leave it more stretched than at the peak of the tech bubble. And it seems that's the reason Buffett has pulled out such a massive sum of money from the equity markets, as T-bills are now yielding more than the prospective return on stocks. Some are also pointing out that Berkshire has now reached a size at which it can't replicate its long-run record of deploying its profits and handily beating the market. It is going to have to hand money back somehow, probably through a dividend. And that means Munger's usual plan of not interrupting the compounding cannot go on as it is.